I'm Dan Fitzpatrick here at stockmarketmentor.com. I want to look at Meta today. So the company reported pretty strong earnings, surprised the hell out of Wall Street. Stock gapped up a lot, opened at 325. Yesterday's close was at 298. So 8-9% gap up, and pre-market it was up even higher. And so this is a stock that I think ultimately the trend is higher. There's nothing wrong with this. How can you look at this and say, well, it looks toppy to me? It's not, but it does need to settle in a little bit. But I want to explain to you what we did at Option Market Mentor. Yesterday, I put on what I call an iron condor volatility crush trade, where the idea is the cost of options as you go into an earnings report is really, really high. That's just the way it is. And the more volatile a stock is, the higher they are. In other words, they're really expensive. So the idea has been to look at the probabilities in the options market and sell a call and sell a put that is outside the expected trading range of the stock that the options market expects it to go. And then the idea is, like in this case, the stock gaps way up. So any puts that you sold are essentially going to be worthless. If the stock gaps down, any calls that you sold are essentially going to be worthless. But if the stock runs up way too far, or falls down way too far, then you actually lose money. So what we did was sold a 325 call yesterday, but we bought the 330 call. So we have what's called the bear call spread. And then we also sold a 270 put and bought the 265 put to protect ourselves. So what we have is a bear call spread, a bull put spread, and the credit that we got, I think it was about 91, 95 cents. And the risk that we're taking is $5. You're not going to excuse me. I'm excusing myself. The risk that we're taking is $5, but we've got a credit coming in which reduces that risk. So what I had done is I just kind of calced where the break even was, and if the stock is up above 323, then we're gonna be losing money on this trade. And indeed, it was up above 323 this morning. And it hung in there for quite a while before finally drifting lower. And so the idea on this trade is you want to be hanging tough. You want to wait a while after the stock gaps up, because so many times, and this thing, I think at one point it was up at 326 or higher, is up almost 10%. When a stock gaps up that much, it's very rare for it to keep going. Sometimes they will, but that's why you have a hedge in place. But typically a stock like that, it's buoyed up there because there's a lot of retail buying. People are rushing to get the stock. They wish they hadn't sold before. They got to get in. They got to be the first one in before everybody else catches on, which the joke is everybody has caught on. That's why the stock's up so high. But at some point, that money runs out. Why? Because only the poorer capitalized traders are the ones that make that stupid decision. Everybody else sits and waits. And so once all that buying's exhausted, the stock's ultimately going to fall just from its own weight. Like there's nobody really massively selling or anything like that. It's just that nobody's really buying anymore. So by being patient with this trade, we're just patient with it. We are now up 67% on this trade. As long as the stock holds below 325, and you know it's gonna, as long as it holds below 325, we're going to pull in 100% profit on that. The money that we got for selling this yesterday, we're going to be able to get to keep it all. Stock should trade below 325. And we do that every week. We do this over and over and over at Option Market Mentor. So by the way, if you're not, and if you are a member, you know what I'm talking about. If you're not a member, you may want to give it a try. My bet is you're going to stick around because I'm going to make you money. All right. I'll see you guys next time.